So welcome everyone to this webinar series we are running called Building Your Business Value. Rubik's has run a number of these webinars this year. Our aim is to provide knowledge and guidance for business owners from experts in their field to help them succeed. Client success is really what is driving us. If I could move the slide. Yes, awesome. Some housekeeping. First of all, please, if you've never attended a Zoom meeting before, welcome Zoom. But please mute yourself. The point of muting yourself is if there's background noise, it does take away the view or the spotlight away from the presenters, and we are desperate for the spotlight, especially in isolation. Secondly, we are recording this session, so you can get a copy of this presentation. So please contact us. We've also got copies of the previous webinars that we've done. The previous webinars being taking control of your super, property development, and also what should business do now to have a successful year. So if you want a copy of them, please contact us. Also, we will have questions at the end of the meeting. So if you do have a question, please just drop it into the chat box section, and Laken will be moderating the questions right at the end. So if there's a question along the way, please feel free to just send a question and we'll deal with it at the end of the meeting. While I've got everyone here, I'm a captured audience as such. I just wouldn't mind just touching a little bit on Rubik's. We advise we've advised to a wide variety of business clients in different business life cycles. So we thought this topic today will be really useful for many businesses, regardless of what business life cycle they sit in. The topic today, as you all know, is first of all, is on the screen. So this is what we will be covering, ranging from business valuations, how to scale your business, how to remove yourself from the business, and how to save that tax at the end if you sell that business. We've got some great speakers today, some experts in their field, which is really impressive today. Speaking of experts, we first of all, I'll just introduce Gareth Bahanas from BBSC. Gareth is a business advisor who has earned his reputation as a difference maker over the past 30 years working in the IT and oil industries. His highly competitive and driven nature is balanced with the intuitive ability to build positive relationships and get the best out of everyone. Gareth makes a valuable difference to the culture, sales team, customer experience, and business improvement and profitability within their business, and also speech therapy for me. The second speaker will be Eliza Smith. She's a client manager at Rubik's for the past 3 years and has over 11 years experience in advising small to medium-sized businesses in accounting and tax space. Eliza is a chartered accountant who has a fantastic commitment to her staff and clients. She's a mad Essendon supporter and a wine connoisseur. Not sure if those two things are connected. She is also the co-president and founder of the Females in Accounting Networking Group. And lastly, myself, I'm a partner. My name is Stuart Coulthard. I'm a partner at Rubik's, which is celebrating 10 years this year. I have over 20 years experience in advising businesses throughout Australia around tax, asset protection, and business advisory, with our focus on showing the Rubik's care factor. I was nominated for the Partner of the Year in 2019 in the boutique accounting space at the Accounting Awards, which went off, by the way. And I'm also a mad Essendon supporter, but I don't want to talk about it. And I'm also a keen runner and a sourdough baker. Now I will hand over to Eliza, who will discuss a topic about what most businesses have an interest in, improving your business value.
Thank you, Stuart. As Stuart mentioned, my name is Eliza Smith and I am a client manager at Rubik's Business Accountants with over 11 years experience, making me feel a little old, but we are getting there, and I've probably seen my fair share of businesses that grow and how to make them. So this is what I'm going to share my knowledge with you today. So I'm here to present to you the influences of business valuations and also touch base quickly on how we value a business. I won't get into the nitty gritty because I won't bore you, because this is not the most sexiest of topics in accounting, but it is also one of the most important tools. So to kick off, Stu, why prepare a business valuation? These can be used for a number of reasons. Selling a business, you'll need a value when you're selling your business, and you want the best value for that business. If you're purchasing a business, the business that you're purchasing will need to prepare a valuation. This also determines if the business is actually worth purchasing or not. Succession planning, determining the most successful plan for you to leave your business or sell your business, and also estate planning. This will also take into account the tax consequences, which Stuart will speak to you about soon. Growing a business. Evaluation can be a great starting point on how to grow. So you get your base level and then you grow from there. Funding. Bank funding, any funding at the moment is one of the hardest things to obtain. And at the moment, we're seeing that they are requiring a business valuation in some circumstances. And benchmarking. How do you compare your business to other in your industry? Valuation is also a good tool to get this underway. So what do you think your business is worth? What would you like your business to be worth? How do you get there? You plan. As much as we all want that value to be as high as possible, we also have to make sure that it's attainable and realistic. We also need to set that time frame. 24 hours and overnight will not help you. It will not help you increase that valuation. So we'd like to set at least a 12-month plan to grow that value. We need to put measures and strategies in place. This is mainly around your profit levels, but also your cash flow and your assets and liabilities. As I mentioned before, preparing a valuation as at today is the perfect base, and we can help you with that. So this is probably the part where most people will either zone out or glaze over, but I'll try and make this as easy as possible. In the business world, there are 3 of the most common valuation methods. Well, the first one is the net asset method. This is for companies, for example, like a leasing company that hold a number of physical assets such as cars and trucks and equipment and lease out to other people. How this is done is the market value of the asset less any liabilities owing to those assets. The second one is the capitalized future earnings. This takes into account your last 3 years' profit and also is multiplied by your return on investment, which is also known as the risk and the number of years that you are looking for a return on your investment. Number 3 is the earnings multiple, and probably the one that we at Rubik's use the most for our clients. The profit or the earnings before tax figure is multiplied by a factor to determine the value. This multiple is determined by a number of factors and also by which industry you are in. So now that we've planned and we've picked the perfect valuation method for you, we're going to look at the next steps of what influences your value. The 4 most common ones are the risk, cash flow, profit, and add backs. So risk, every business has it, whether it's internal, external, and whether you can control it or not. Some of the internal risks are your technology. It might be out of date, you might not be updated, or you're not up to date with the common methods in your business. Your staff. As much as we all love our staff to be trustworthy, they may not have the proper experience and proper qualifications to do the job. Outdated policies and procedures. If you're running a business like you did 40 years ago, guarantee that that's probably one of the biggest risks you can have in obtaining the greatest value for your business. External, competition. Probably the largest risk you can have. What are your competitors doing and how are they outdoing you? Economic factors. Today is one of the biggest things with COVID and economic factors. The word recession is such a dirty word, but it also can be a risk for the value of your business. Government decisions. Stage 4 in Victoria has shut so many businesses down, and unfortunately, this will have a detrimental effect on valuations for a business. However, we will try and mitigate these and improve on them. Environmental matters. If you're a business that deals with the outside world, physical, such as gardening or landfill, environmental matters is going to heavily impact your business. This risk factor is used to multiple for your profit and also to get your valuation. It also can be measured as the number of years as a potential purchaser will be expecting a return. So say, for example, if I want to buy your business and I want a return on my money in 10 years, then your risk factor will more than likely be 10. Cash flow. Every business's nightmare or saving grace. So for cash flow is your ability to collect the money owing to you and also pay your liabilities. This ability will affect your valuation. If you're using the net asset valuation method, if you have a high level of liabilities, then this will reduce your valuation. Also, if your liabilities are high and your cash flow is low, it may be seen as a deterrent for businesses to actually buy your business. Profit, everyone's favorite word, and also this is probably one of the most important influences on a business valuation. Most business valuations are calculated on your profit or your EBIT. Your EBIT is your earnings before interest and tax, and it is also commonly used with your profit. The profit is also one of the easiest influences to change. We can assist you with that. You flick, Stu. So during the planning phase, we will look at your profit and loss, and we will analyze and make sure that we have the best strategies in place to increase your revenue and decrease your expenses. Most valuations are based on rolling profits. So your first year profit is a base, and then the strategies in place will be next 2 or 3 years, but also something that can reduce or increase your add backs. So for a business valuation, the only transactions that are factored in are the ones in the ordinary course of business. In your financial statements or your tax returns, as you've seen, you would have seen your income and expenses. However, for your business valuation, we only want to look at the day-to-day transactions. So anything that is out of the course of day-to-day will either be an add back or a deduction for your valuation. This will also just make sure, if we go back, Stu, sorry, focus on that the valuation is just on your asset value, your goodwill. So how much time and effort you have put into this business and how to grow. It's not a figure that you can easily measure, but if you've been in a business for 10 to 15 years, we need to put a value on that to make sure your valuation is at the highest. The add backs and deductions ensure that it is just on the values based on asset value, goodwill, and profit. These add backs and deductions are applied to the profit before tax. So some easy examples of add backs and deductions, and through every step of a valuation process, we will be there for you and we can explain these to you. Some examples of the add backs are extraordinary legal costs. So say, for example, if you have an employment matter and it's not to the day-to-day running, then we will add that back for valuations. If you sell any physical assets and you unfortunately don't make any money off them, any donations that you make are not seen as in the ordinary course of business and will be added back. Depreciation, anything that you claim, including the small business pool, will be added back to your profit to increase that bottom line. Any interest paid on loans or to the ATO or any other parties, this will be added back as well. And also, if you own a business and pay yourself a salary that is above market value, then this will get added back. This also includes any superannuation you pay yourself. So what will reduce a valuation will be if you make a profit on the sale of assets, because it's not considered in the normal day-to-day business, any recoveries from insurance, and also any interest you've received. So what's your next steps? What can your valuation be used for? Once a valuation has been calculated, this can be used for a number of high-level and strategic business decision-making. Will you continue? Will you sell? Will you grow? Will you franchise? These are some of the biggest reasons. At Rubik's, we prepare a business valuation and also a tailor-made plan for you and your business. There's no cookie cutter way, and each business valuation and plan is going to be different. So what can the valuation do for you? Gareth will show you the next step.
Excellent. Thank you, Eliza. And don't worry, I was right with you when you talked about valuation methods. I got very excited. And I'm glad you talked about multiples as well. Now, interesting thing just on valuations. Now, most people know the value of their house. Very few people know the value of their business. So if there's ever a reason, your business is probably your largest or second largest asset. Work out what it's worth, and talk to Eliza in the game. Now, multiple for me is a good thing because it reflects the the quality that your business is, because the higher the multiple, the higher the return, which reflects a better run business. Now, for me, whether you're looking to sell your business or whether you're looking to scale your business, the process is very similar, right? And I'm going to step you through 4 key areas that we'll focus on. So next slide, please, Stuart. So the first area is time. Click. Thank you, Stuart. Well done. So time is where you as a business owner is spending your time and how effective it is, right? So, and also you can run this through also with the rest of your staff. The second area, systems, is how you are maximizing the efficiency of your business operations. Next is talent, having the right people in the right place, doing the right things. And then finally, planning and sales, right? What are your plan and what's your sales processes? Next slide, please, Stuart. Okay, so on time. Now, there's a fallacy. It's that old chestnut, you know, the one, if you want to get something done, give it to a busy person. No, really? If you're a busy person, do you want to be asked to do something extra, particularly if it's someone else? No, right? Now, since 1960, Australia's productivity has increased by over 500%, yet we are busier than we have ever been. So the thing is, it's not about productivity, it's about effectiveness. We all have one thing in common, which is time. We're all given 24 hours in a day, and it doesn't matter how wealthy you are, you cannot buy an extra minute, right? But what you can do is do more with what you have. Now, business owners, generally, we know they're working 60 to 80 hours a week, and they are sacrificing a lot of things in that process. So we want to get better at it. Now, if you're a solopreneur, or if you're providing professional services, the key thing that you are selling or the resource that you are utilizing is time. So we've got to get more effective in how we use it. And being effective means maximizing the return that you're getting from those things. So let's have a closer look at time. Next slide, please, Stuart. Okay, here we are. We're going to do an assessment. Now, I know you're probably as excited about doing a time assessment as you are on valuation methods. But before we get into this a little further, one of the things that I do when I'm working this exercise with my clients is we establish 2 things. First thing is, what's the best value that you as a business owner bring to the business? And the second is, how do you want to spend your time? So once we've established those things, then we go into this little assessment sheet, right? And basically we do this over a 4 to 5 day period, and we're assessing what you're doing in 15 to 30 minute time slots. Now, you're probably all busting to get a hold of this right now because it's all the things that we all love to do. But what we're looking to do, once we've gone through this exercise, we're identifying what sort of activities we're doing, and then whether they are the things that we should be focusing on. Right, so next slide, please, Stuart. Right, now, what we're going to be looking at is terms of those areas that you're doing and those things that you're deciding. Now, with the doing, we all have to do, and any given time, 70% of our activities will probably be focused on doing, because that's all about a deliverable. But sometimes doing is just stuff, and it's dangerous because we can fall into a comfort zone. We fall back into those things that we feel safe and secure in because that's what we've always done. That's why we started the business. But it's not necessarily the best use of your time today. The other thing is we start doing things because we lack confidence in some of our people. So the next area we look at is the amount of time you're spending on deciding. Now, decision making is very important, but if you're making too many decisions, then that's a problem, because now you are the center of the universe and all roads leading to you, and you are becoming the single point of success or failure in the business. And the thing is that once that sort of thing starts happening, you cannot scale. So once we've done all of this, we need to then start looking at it and going, all right, so how do we reduce, stop, and delegate? So reducing is looking at each particular activity that we say that you should continue to do and how you can reduce the amount of time that you spend on it. Stopping is very clear, right? It's just saying we need to put a line through it. It's actually not necessary anymore. And the third area is delegating, right? What are those activities that you can get to be done by other people? How do you empower your staff to make decisions without you being involved? Now, if you're, for example, if you're a business owner and you reckon that your time is worth $250 to $350 an hour, if you're spending 5 hours a week doing invoicing, or if you're spending hours a day just trawling through your emails, it's probably not the best use of your time. And maybe you could use a lower cost resource to be doing that, right? You might actually enjoy those things, don't know why, but you might. But that's not the best use of your time. Now, I'm going to give you a quick client example. So I have a client, he wants to continue to grow his business, but he wants to reduce his effective working time down to 4 days. So we did this assessment and we determined very quickly how we could save 25%, right? And as a result of that, he's put in place a number of changes in terms of delegation of activities, eliminating things, and he realized that there was a change that he needed to make in the structure of his business. Next slide, please, Stuart. So here we are, right? This is the problem. We have the superhero in the business, right? And we have, so we are at this point, we're wanting to put an end to the superhero. We're wanting to put an end to the center of the universe, right? Stop making all of the decisions, stop doing too many things, stop being the limiting factor in your business. Now, if you're looking to sell on as a prospective buyer and they come along and they see that the single most important factor in this business is the owner, the value of the business diminishes, right? If the single most important factor in the business is the owner, then it's also not scalable. So sadly, we have to put an end to the Cape Crusader in your business. Next slide, please, Stuart. All right, so if you thought time assessments gets people excited, wait till you get into systems, processes, and documentation. So how well are your core systems documented? 100%, 50%, a few, they're all in your head. Buyers, again, looking at your business, we'll be looking to see how well it runs. And from that, if they can see that you've got well-documented systems, they have greater comfort, and the risk that Eliza was talking about is a little bit less. Yeah. So if you've got really well-defined and mapped out processes, your ability to scale and step down as the superhero is also much easier. So when was the last time you actually stopped to have a look at the effectiveness of your processes? I'll give you another client example. So at the moment, I'm working with a client and we're going through the core process of this business. And we've identified each step, and there might be 24 steps, right? And then in each step, there are sub-steps. So we're again at this point, each step we're looking at what is the purpose of the step? What's the desired outcome of the step? Who's responsible to do it? Who's actually doing it or should be doing it? What are the issues in that step? And then what is the strategy to resolve those issues so that we can create a more streamlined, effective process? Once you do that, then you've got a scalable mechanism happening, and it means you can actually do more without having to keep adding in extra people. You also have a foundation which allows you for faster acceleration of your business. And everyone knows what it is that they have to do and how well they work together. And it stops people running back to the business owner to get guidance and answers. Next slide, please, Stuart. All right, time now, tick, we've done that. Systems, tick, we've got that going now. People, talent, this is probably one of the most frustrating areas ever, getting the right people and keeping them. So with this, a question, do you have a documented hiring and onboarding process? Do you have clearly defined values and a business vision? What's your culture? Now, I have a little thing which I called my Kool-Aid check, right? Where I go into an organization and I test the Kool-Aid. And It is where I do a 360-degree interview with the staff to get their views on what it's like working in the company, what works, what doesn't work, what's the culture like, what's the business owner like. Now, you'll be surprised that not everyone actually thinks that it's a great place to work or that things are swimmingly good, right? There are lots of frustrations, which sadly, sometimes business owners and even managers in large organizations don't necessarily see. So getting and retaining staff can be a real challenge. So how do you go about getting, do you run an ad? Do you reach out to friends? Do you lean on family members? Any of these are a good mechanism, but nothing is a guarantee that you're going to keep these people or that they are going to be best to help you achieve your growth goals. Bringing people on board in the first 3 to 6 months, 60% of them are going to make a decision whether they stay or go. How well you actually can bring them in, if you do it right, they'll stay 3 to 5 years. But getting it right is hard. And it's one of the most neglected areas when it comes to talent management. So often we just bring them in because we're all busy and we give them a basic orientation. We might give them an outline of the sort of things that they need to do with their job outside of what we talked about in the interview. And then we throw them out and just get on with it. What happens then for some of these people is that their frustration levels start to build because they're struggling. They don't quite know how to do things. There's no documented processes. They have to keep going back to the business owner. Then they get to the point where they feel that they're not set up to succeed and they leave. Or the business owner is going, you know what? Oh, this person promised so much during the interview. The resume looked great. They're just not delivering. And then they get frustrated and then they fire them. And then we get into rinse and repeat. And then eventually the business owner says, you know what? Stuff it. I'll just do it myself, right? Thing is, you don't need to do it yourself. There are ways that you can work and develop your people to make them more empowered, more engaged, and more effective in your organization. And then let me tell you what a potential buyer finds really sexy is coming in and seeing a really well-drilled, disciplined team that works together, because they know once the business owner says bye-bye, the business still keeps running. Next slide, please, Stuart. Oh, and here's another beauty that we all love, business plans. Yes. So do you have a business plan? Have you got a 1 year or a 3 year plan? Have you got quarterly targets? Do you have monthly goals? Now, a plan actually is really valuable from the perspective of helping you in your direction, but also if you want to go to market and get funding, then having a clearly documented plan is very important. Now, I know there are amazing entrepreneurs out there like Richard Branson, who talked about how he wrote most of his business plans on a serviette. Well, I'm quite sure that by the time those businesses started growing to 100 to 100 million to $1 billion enterprises, the use of serviettes was restricted to the serving of sandwiches in the boardrooms. Now, a business plan doesn't have to be a 100-page tome. It can actually be consolidated down to 1 or 2 pages. But it's your GPS. It's showing you how you are tracking to your goal. And business plans are never in stone. They are not perfect. They change. They're not linear. But they are so important, particularly around helping you, as I said, know how you're tracking, what you have to adjust. I'm going to talk very quickly here on also sales, right? Linked to this, right? Do you have budgets for your salespeople? If you don't, then you need to, because they need to understand what it is that they have to do. But in sales, there are 3 things that you need to focus on: how you're attracting customers, how you are converting customers, and how you are delivering on your promise. And if any one of those 3 is not quite there, then you've got a problem. So for example, with conversion rate, right, you're doing a good job, you're getting all these prospects in, but it's just not quite converting. It might be a problem with your sales process. It might be you don't actually have a sales process. I'll give you a client example. I got an approach from a business owner who after 15 years said he was exhausted. He felt like he'd been carrying the responsibility for sales generation all this time, and he'd hired and fired dozens of sales reps. So I did my Kool-Aid check, right? And what I discovered was that, yes, there was a lot of sales reps that came and go, but there was no sales process. There was no support mechanism. They came in, they didn't know what to do. They didn't understand the business. They didn't feel they were set up to succeed, so they left. If they didn't leave, the owner sacked them within 6 to 9 months before they ever got to the chance to produce any results and return on investment. So there are two things. One, there was no process, and two, he was an obstacle because he didn't know how to distill his knowledge back to them. So when was the last time you reviewed your sales processes? Do you actually know what your break-even point is with your sales people? Next slide, please, Stuart. All right, so summarizing, we've done all of these things. We've now cured off the Cape Crusader, right? There's no more center of the universe inside the business. Next slide, please, Stuart. And as a result of moving through all of these areas of business, maybe your business has moved from something that looked like this to now something that looks like this. A highly polished, high-performing machine. And once that starts to happen and the business and the profit levels have started accelerating and you're now looking to sell, and next slide, please, Stuart, and we're moving into a potential buyer who may give you a multiple of 5, this is when you need to engage Stuart, because he can help save you thousands and thousands, maybe tens, maybe hundreds of thousands, maybe millions of dollars of tax. I probably went too fast, Stuart, did I?
Thanks for that, Gareth. I'll see what I can do in terms of millions of dollars in tax.
Thanks, mate.
So now that you've valued your business and scaled your business, and then you've got a business sale, the last thing you want to do is actually pay too much tax. In reviewing a business sale, tax does need to be considered. A lot of business owners that we actually talk to don't even realize that tax is payable on gains of business sales resulting from business sales or profit. At Rubik's, we do a number of transactions of business sales, and we do provide advice in reducing the tax on the sale. The common theme in reducing tax, however, is planning. It's really hard for us to provide actionable advice if the transaction's already occurred. Early engagement means a better practical advice. I just wanted to cover off on a couple basics first when you're selling your business. If you sell your business and make a gain, this is a capital gain event, meaning it needs to be reported to the ATO. How is a capital gain calculated? Pretty simple. You've got your cost base less what the business is actually sold for. The cost base usually is what you purchase the business for. So if you started the business yourself, your cost base could be 0. How much tax will be payable is depending on a number of factors, and I'll run through a couple. First of all, the cost base, so depending on how much you paid for it. What is the structure the business is actually operating in? Is it a company? Is it a trust? Is it a partnership or a sole trader? And also the contract of sale, the date of the contract, and also the timings of the payments. So I guess there's a fair amount of complexity around how much tax you're actually going to be paying. And knowing this before the actual business sale goes through is really perfect and ideal. Obviously, if you make a loss on the business sale, you don't have to pay any tax. So that's great, but you've made a loss. This is called a capital loss and can be carried forward to be offset against capital gains for the future. If your business was actually set up before capital gains, which was the 20th September 1985, then there's actually no capital gains tax payable there as well. Anything after this date, CGT, is applied. Now if you have made a capital gain in the business sale, there's a few ways that we can actually reduce that capital gain. What these ways are called is Small Business CGT Concessions, which is applied to reduce that capital gain, and that's tax payable down. Sometimes we've actually got that capital gain down to 0, which is awesome. So the first thing when we review on whether people have got to pay capital gains on business sale is, first of all, and whether we can actually reduce that using the CGT Small Business Concessions, is first of all, see if you're eligible for it. How are you actually eligible? First of all, you've got to be running a business and selling a business which has got some active assets in it. So you can't be selling an investment property. You can't access those rules here. Your turnover, being your sales, needs to be below $2 million right before the sale. And also your net assets in your group needs to be below $6 million. This is not including your personal assets such as your home. If you've met these conditions, I note there are some finer points in these conditions, and I am being very general here. So if you are thinking about selling your business, talk to an advisor, talk to Rubik's to see if these rules do apply to you. Again, if you do meet these conditions, you may be able to actually use these small business tax concessions. I'll delve in a little bit further into the maximum net assets test. So when testing the $6 million net asset tests, we do need to look at your total group and its assets. What is your total group? First of all, we include you and your assets, any entities that you're connected with, and affiliates and entities connected with your affiliates. An affiliate will be an individual or a company that you control. So potentially your husband and wife. So we've got to group everyone there to test to see what assets are there. So if you're below $6 million, these concessions, which I'll run through soon, will be applicable to you. The next is, are you actually selling a business, and do you meet these tests? The ATO used the term active assets when describing what a business asset is and the applicable capital gain. So on the screen here, I've got a couple examples. So typically when a business is selling, they're selling their goodwill. So that is technically an active asset, and you can apply the assets here. A shop or a factory. What's not included as an active asset and won't be applied to these rules is your work in progress, typically your debtors, factories not rented out to related parties in the business, and plant and equipment, which is typically what we see, and assets owned in a self-managed super fund as well. If you are selling the shares in a business or an interest in a trust, rather than the actual business, to access these concessions, you need to be a CGT concession stakeholder, which is typically 20% ownership. Now, we've worked out whether you're actually eligible for these concessions. What are these concessions and what are they available? Here on the screen is what they actually are, and the actual order that we usually run through, or sorry, the order that you run through when you're actually applying the concessions. So I'll delve in a little bit deeper now. The first thing that we run through is, first of all, the 15-year exemption. What this is a concession. If you can meet this concession, you don't have to pay any tax at all. First of all, you need to be owning your business for more than 15 years, and it's got to be the same people as well. So if there's been multiple changeovers of ownership throughout the last 15 years, you're not going to be won't be able to use this exemption. If you're an individual, you've got to be over 55. So if you're less than 55, you won't be able to get this exemption. As well, it's got to be connected with a retirement event. So again, if you meet those tests and you're a small business, yes, you'll be able to actually use this concession and pay no tax. So the next thing we do, we work out, first of all, the applicable to the 15-year. Then we go, okay, you may not be applied to that. Let's apply any carried forward capital losses. So reduce that capital gain from the sale of your business by any capital losses that you've got. Then we move to the next step. The next step is the general 50% discount. How does this apply to you? First of all, you've got to be owning your business for more than 12 months. So if you own your business for more than 12 months, you get a 50% reduction in your capital gain, and that's a 50% reduction in your tax. If the business is a company and selling the business, companies don't get access to this 50% discount. But if you're selling your shares in the company, you do, depending on how you're owning those shares, you do get access to the 50% general discount. Then we move to the next step, which is another 50% active asset reduction. So you get two 50% reductions in your capital gain. How do you meet this? First of all, you need to be selling a small to medium sized business. So below the 2 million turnover and the 6 million asset, and selling a business. So if you meet the general discount and you meet this active asset reduction test, you actually get a 75% reduction in your capital gain, which is a magnificent event. So you can use this concession with the next one, which is the retirement exemption, or the rollover one. So you can pick and choose which one you want to use, and picking and choosing can make a big difference. So, this is the sort of strategy we play around, making sure that you get the best result in applying these concessions. So the next one, which is an interesting one, is called the retirement exemption. This retirement exemption, you don't actually have to retire. You get a lifetime limit of $500,000. So if you sell your business for $400,000, for example, you can actually apply the retirement exemption and actually write the whole capital gain off and not pay any tax, because again, you get a $500,000 lifetime limit. If you sell 2 businesses for $400,000, then you only get $500,000. So it's a lifetime limit. If you are below 55 years of age, you actually have to contribute that capital gain into super. So again, if you sell your business for $400,000 and you apply this retirement exemption, you have to put the whole $400,000 in your super fund, but you won't be paying any tax. But again, it's locked away in your super fund. If you're over 55, you don't have to put it into super, which is a great result. So thinking about using this one is a great result, and applying a great strategy will get you away with minimal amount of tax. You can pick and choose which concession you want to use and which order as well, apart from the top one, being the 15 years. So using the concessions correctly will make a big difference. The last concession that I want to talk about today is the small business rollover concession. This is where you don't choose to use any of the exemptions and you want to actually roll the capital gain into another business venture. First of all, you've got 2 years to do this. So you don't have to do it today, but you need to do it in 2 years of the actual capital gain event. And it doesn't have to be in a business. It can be in a replacement asset. That could be a factory that's operating in a business, or it could be, another business. So this isn't a final disregard of capital gain, because there is it will be deferred until the actual taxing point when you eventually sell that second business. So you will be paying a further amount because your cost base is coming down. So using all those, applying all those concessions in the appropriate order and applicable to you can reduce your capital gain. But again, as I mentioned, doing this before the transaction and working out the taxing point is the most important thing. Again, it's really hard for us to provide actionable advice before the event. So knowing about them first and then applying them before the event is ideal for us. Now, that's the end of the formal presentation today, but I wanted to touch on first, while I've still got everyone, we are running another webinar series designed to further educate all our business clients and everyone out there in the community. And the topic will be structuring your business correctly. So we are seeing a little bit more activity around the ATO and creditors. So getting the structure right for your business, especially, selling your business, you can save tax and also protect your assets. So again, that's going to be late to October. What I might do now is just check in on Laken to see if there's any questions. I'm sure there's thousands, but please just moderate them a little bit so we can deal with a few. Laken, do we have any questions?
At the moment, I haven't had any that have been sent through.
That's okay.
Which is good. It means we've done a big, oh, here we go. What sort of asset is a trademark registration?
I would probably generally say that's an active asset. That'd be correct, wouldn't you, Eliza?
Yes, it is. And it's also an intangible. So yes, so you can't physically touch it, but it is still an asset.
So generally when you're selling a business, you'd be thinking, okay, what does the new business owner need to use to operate the business going forward? A trademark asset would be going with that. And it's not typically, and they do list out what are non-active assets and plant and equipment, things you can sell without the business is typically a non-active asset. Any other questions?
That's all so far.
Which is cool. I'm happy with that.
Oh, here we go. If you are starting a business and one of you is over 55 and the other, a family member, is under 55, would it be advisable to have the business in the name of the older person?
I guess when you're structuring a business, which is our next topic later on, so maybe tune into that for some further detail. But we do review the stakeholders when thinking about structuring the business. I guess it depends on your personal circumstances and also depends on risk. So when structuring up a business, risk comes into it. So, and also if tax comes into it as well as the eventual business sale. So potentially it could be a strategy. but I probably have to talk to you a little bit more to see what you actually want to get out of the business. Because not being involved, if you're the younger person, can have longer term consequences because you don't have control of the business. The person who's 55 and over could have more control longer term, and that may not suit you. Anything else?
Yeah, I've got another one relating to small business CGT concession for over 55s.
Yep.
They've run the business for over 15 years. If there's two partners, do they both need to be over 55?
So we've had this circumstance in the past, and what actually happens is that it depends on how you structured the business up. The portion of the person who's over 55 can access the 15-year exemption, and the person who's under 55 doesn't get access. So you kind of split the capital gain. Again, I was being very general in that conversation and those topics. You would have to get down to the details to make sure if that's actually correct or not, because it hinges on the facts of the case. So again, give us a call if you want us to delve in a little bit to see if it's actually applicable to you, because that 15-year exemption is a great outcome for any business sale, and getting that right. What we've done with that live case was actually held off on the business sale for a couple of years for that second owner to turn 55, so we could access the exemption.
I have another one. If you were just starting your business out, what sort of time frame would you say would be optimal to prepare your first valuation?
That's a great question, it's difficult to pinpoint an exact time. I think you have to have a consideration of how long you're going to be for and what you're trying to achieve. So I think if you're starting to turn a profit for a couple of years, then I think that's a starting point. If you're in the business for 5 years, I would probably go year 2 or 3. Most businesses that we see are in for the long term. So I think if you're turning a profit for more than 3 years, I think that's probably the first time to do a valuation.
I'd probably also cover off on what Gareth said. Most people don't know the value of their business, but they know the value of their house. So if you've got a need for a business valuation, there's no reason why you can't get one done. Sometimes there's outside factors on getting a business valuation done, and sometimes that's banking funding and also insurance related too. So if you do have an outside or third-party need for business valuation, you get one done. But also knowing your business valuation, so setting a plan in place, again, what Gareth mentioned, you may say to me, I want to make my business value $2 million in 2 years' time. Without getting a business valuation done, you won't know if you've got that $2 million business value. So we have a lot of clients that we do business values every year, or a business gap analysis, just to see if they're actually meeting their business goals.
That's all I have at the moment. I haven't had any more sent through. If anyone does have any quick ones they want to pop in.
That's fine.
What comparable sales data do you use?
I'm assuming business value, yeah.
I guess for the sales, for comparison, we look at the industry. So we look at the benchmarking rate with the HO, and also we use the software that gives us the benchmark for sales, but also like against their own. So say, for example, if it's cyclical, so if it's 1 year is high and the next year is low due to a number of reasons, that's what we normally benchmark it on. So it's also external and internal history of sales.
Cool. All right. We might finish it off there. Again, thank you very much for everyone coming along. And I hope you do got some value out of that. Again, I might go back if I can. There is our contact details for both Gareth, Eliza, and myself. Quite happy to have a conversation about any of these topics that's a bit more specific to you, because they were pretty complex stuff. Look out for our next webinar series. Again, they're all aimed for business success for our clients and our business community. So please check in on that. So again, thank you.